We have esteemed panelists here. They really need no introduction, but for the sake of the procedure, I will just introduce you to the panelists. Leo Puri, Chairman, CI 12th Mutual Fund Summit and Managing Director, UTI Asset Management Company. Nimesh Shah, Managing Director and CEO, ICICI Prudential Mutual Fund. We have Milind Barve, who's the Managing Director, HDFC Asset Management Company, and A. Balasubramanian, who's the CEO at Birla Sun Life Asset Management. Well, we've all discussed in the beginning of this session on how unprecedented has been the growth in the mutual fund industry, and that is really the talking point. I mean, we talk about it when we hear our own drivers, our own domestic help talking about it. So I think that Sahi Hai campaign that the industry had taken has clearly touched the chords of individuals in a big way, and that we are seeing in the kind of numbers and inflows we are seeing in the mutual fund industry. Now, the subject that here we are talking is growth in Indian asset management industry. Is there a new normal? I think while we are all very happy and elated with the kind of growth one is seeing in the mutual fund industry, the challenge is, as we had heard Mr. Mahalingam also talk about, sustainability. How do you ensure the kind of inflows that we are seeing today continue in the same pace, or at least be sustainable going forward? And that really will be my opening question to the panelists here, to understand from them how are they preparing themselves for the bad times, because clearly these are good times, which we all know will not last forever. So let's get to understanding from each of them at their own individual capacities and at their individual organizations, preparing themselves for the worst, because this is going to be a cycle, isn't it? Let me begin with Mr. Puri.
Well, it's not so much good and bad times, but as you say, cycles. I prefer the term cycles because on both dimensions, otherwise good and bad, I think we go off track. I mean, we know we are in a cyclical industry, and of course my colleagues here are all veterans who've seen cycles. But first, on the good news, as regards good news, sustainability in part in our country comes from just the fundamental changes. We've heard about financialization, shift from gold and real estate, flows, emerging middle class coming into financial savings. So that is a very strong source of sustainability. So our industry is, as you heard earlier, on very strong foundations. To that extent, we don't have the problem some other markets do, where there are questions even about, over maturity or oversaturation. So then it's really down to us as an industry and to some extent down to the regulator to determine how they're going to essentially map out a future path. The industry has taken a lot of steps to ensure that in terms of its internal processes, whether they're investment management processes, whether they're customer servicing processes, whether they are risk management processes, that we prepare ourselves for cycles.
Sure.
The regulator will have to satisfy himself or herself that what the measures we have taken are indeed robust enough to withstand a cycle, because we know we're in a cyclical industry. You heard them say that they believe that systematically they perceive higher risks than we might do as individual institutions.
Sure.
So beyond what I may believe as UTI or Nimesh may perceive as ICICI, if they're going to perceive a higher order systematic risk, then frankly the issue now goes beyond any of our individual control as to how they are going to perceive that.
Of course.
And as I said earlier, I think I fully anticipate to some extent, therefore, a systematic overlay over and above what all of us are doing as institutions. But as institutions, we should be cognizant that we have done a lot in the last 3 or 4 years to strengthen ourselves for dealing with market cycles.
Sure. Do you want to take on from
Good, Mr. Leo Puri started, says put an overall framework. You should have happy customers 3 years down the line.
Sure.
Right? We will have the cycle where we believe from overvalued market, we can go towards a euphoric market in the next 1 year. But what are we going to tell the customers 3 years down the line? When the euphoria, I don't know when the euphoria will start and when it will end.
Sure.
But 3 years down the line, fundamentals will be striking on us. So people who are coming now, and I see what will happen when the markets cross 34,000, 35,000 as more and more retail come in. I don't want what happened in 2007 to happen again. So at this point of time, more than 65% of what we sell is coming in either balance or what we call as a dynamic asset allocation category, that balance advantage category, whereby only 30 to 35% of the money is getting invested in equity, almost 65 to 70% money is getting invested in debt.
Alright.
So we will keep on changing the allocation. If the market corrects, we'll increase equity. Otherwise, it is more and more conservative products. So I would have happy customers 3 years down the line.
Sure, be conservative in good times. That's the view he has. Milind, do you subscribe to that?
Let's just think a little bit about what's behind this sort of good times to understand your question about sustainability. And I would say that the first thing, as Leo said, is this big and very profound change from physical to financial assets. But what's equally important, probably as important or more important, is that within financial assets, what are people choosing to put money into? And in India, we've had a history where bank deposits was the default and by far the most dominant share. It still is. It still should be also. But I think the beauty is in the numbers. So if you look at data of, say, something as back as, say, March of 2012, bank deposits within household savings of financial assets was almost 60%. If you look at fast forward to March, say, 16, which is a little dated now, that share came down to 41%. Now that is a swing of 17-18% just within household savings. To give you just a color of what these numbers mean, India's GDP is like 151 lakh crores. Don't worry about the zeros, but that's a huge number. And if you look at, say, financial savings itself is of the order of about 18 lakh crores. And assume at 12-13% growth, you're looking at 20 lakh crore plus. What's the most profound thing is, interestingly, that there is the share of bank deposits still going, but it is reducing. And what is it? It's replaced by people wanting to choose more capital market oriented products, and that's where fund products like mutual funds, to some extent insurance is coming in.
All right, Bala?
I still remember 2011 to 14, I was playing the role of Mr. Leo Puri as a CIA Mutual Fund Summit chairman. And one other forum we put a prediction. The industry will see a 20 lakh crore by 2020. And the 20 lakh crore has come actually in 2017. I completely got the math wrong. Right, that's only when I look back and then see the predictions versus the reality. And the math was wrong actually. Somebody even corrected me in the stage itself. Well, your math could be wrong. The 20 lakh crore actually will come a little earlier. By 2020 you will see 20 lakh crore. That's the power of the asset management industry.
Sure.
And the under-penetration, what I think Milind spoke about, what Leo spoke about, what Nimish also spoke about, the long pending under-penetration of mutual fund industry, which I think people took a lot of time to recognize the mutual fund as a platform for saving, that seems to have caught on quite well. Second, the work that has gone behind making this work, I can probably say 25 years of hard work by the industry and finally is catching up. And the last few years of, especially 2012, re-energizing Indian mutual fund industry, first time ever the regulator came out with a note which is called as the re-energizing Indian mutual fund industry. I think SEBI, always the regulatory framework that comes are more of restraining in nature, but this is actually completely different. And that re-energizing Indian mutual fund industry 2012, it took some time to actually look at and how actually the industry has to penetrate. Today, if you look at the mix, I think the McKinsey report also showed that the B15 growth has been faster than the T15 growth. This all means actually the increase in the penetration, the large pool of customer base rising. Second, at down point of time in the 2008 crisis, one of the biggest learning that we had as an industry, how is the mix of assets behaving for the industry? Is it large pool of institutional investors coming or retail investors coming? But if you look at the mix of the industry, it's actually more skewed towards retail and less towards the institutional AUM, which essentially mean from the systemic risk point of view, which could potentially arise on account of interest rates going up or maybe money flow moving out from the country. But all of them, I think, could get mitigated because the switch of assets that has happened between the retail versus the institutional customers.
I want to ask you about the fact that what do you do with the money that's coming in? I mean, the challenge is really, is there a problem of plenty here that you're dealing with the kind of, I mean, you have to get the best returns for your investors. How do you deal with that pressure constantly? Because, the expectations are rising. 20% plus kind of returns is what at least most people expect. How do you deal with that? I mean, maybe we can start with you, Nimesh.
Overall, this point is discussed at every forum, and we are quite, we have got 24/7 media, and we need some issue at some point of time. So in this particular thing, we have got a very, very deep and a huge capital market. We are not, as Milind just now said, we are not even 4-5% of the market overall. We are 5% of the market overall. At 5% of the market, if you are going to worry about this, then we can't talk about growth at all. So we don't think that's an issue, because if so much money has been coming in, there have been regular IPOs also which have been coming out and which have sucked out a lot of money also out. So deploying money, 20,000 crores is, and I've been hearing on stage also that huge amount of money is coming in. But where is, we are in a country where bank deposits in this country are 1 crore or more than that. Right, and we are talking out of that 20,000 crores is coming into mutual funds. Where is it big? Given a year, if 2 lakh crores is coming in out of 1 crore, where is it big? That's where I am not able to understand. So I don't think it is something which is huge, which cannot be absorbed by the Indian capital market, and I don't think it's an issue.
I mean, another slightly different way of looking at it is you have to understand what our industry does. We essentially, investors make a decision as to where to put their savings. They then give it to us. So to some extent, at the time that we receive the money, an investor has already made up his mind as to what type of risk he's seeking. Is he seeking fixed income exposure? Is he seeking equity exposure? Does he want a balanced fund? And either he's reached that conclusion on his own, if he's a self-directed investor, or he's reached that conclusion based upon advice from a financial investor. And I think this is important to understand, because I am not sitting down with an investor and making his asset allocation decision from him.
Sure.
He is perceiving that there are opportunities in today's economy with the macro growth, the political reforms process and all the rest of it, and he takes a point of view as to where his asset allocation is. Once we receive the money, then our investment processes, of course, as Nimesh says, have to be able to actually find the best potential opportunities to deploy. The notion of there being scarcity of supply is of course, it is an issue, but it's an issue for anyone, whether you're coming through a mutual fund, whether you're a foreign institutional investor, whether you're anyone else. And that's why markets are cyclical, because at some point when valuations get out of hand, people find other ways to deploy their money.
Yeah, I think we live in a world of relativity. It's not, so one, as Bala mentioned, it's always good to keep expectations low. I don't think, I have been part of this debate where funds were 10-15,000 crores and we were told about the funds being too large. Now there was number of funds which are 10-15,000 crores plus, now it seems to be fine. So it's just that we keep, creating these issues to talk about. I still feel that we are so underpenetrated, under-owned from the market ownership, not just the retail investors' ownership. And just look at the last, just 12 months, to just give you an example. You've had huge amount of new capital being raised in the form of IPOs. What is not so well documented is true is that there's a huge amount of, anchor investors locked in for 1 year, or pre-IPO investors locked in for 1 year, whose supply is potentially there in the market. There are PE investors who are looking to exit the market once they feel their investments have reached the target they're looking for, and this market is giving them that opportunity. There is disinvestment coming from the governments in form of new listings. There was the new ETF that was launched. So there is enough and more supply coming to the market as well. So it's a good problem to have if we have one. I don't think anybody of us can sit on judgment about a market being overvalued or undervalued. These are all, you can look at rare view and say that, oh, it looks overvalued from this point of view or that point of view. But one thing you must keep in mind, that the markets are incredibly forward-looking. You'll be surprised. You may argue about it, but the markets are rarely looking at 18 or 19. People are already in the debate of 1920, 2021.
Bala, do you think is there a risk of money chasing weaker stocks as the bigger blue chips and so on are already sort of at very high valuations?
So of course, the question is, even if you chase, say, either weaker stocks or relatively smaller market cap companies, the question comes is how much you can own them. So you can own 5%, 10%, 20%, and beyond that you can in any case own them. So where I think the mutual fund size is rising, therefore increasingly the focus will not go below, it will actually stay in the top. Even from the look at the market cap point of view, top 100 companies takes away 80 to 82% of the total market cap. And if you take top 5 companies, maybe it will take roughly about 10 to 12% of the total market cap. Therefore, as it is, the market is very skewed. So also looking at few numbers in US, in about 10 years back, whatever the company that used to exist, the top 5, they are no more in the top 5 today. The entire top 5 companies in the US actually is ruled by technology companies, which all of us are using today in India. There is Facebook, Google, and so on and so forth. Therefore, the market is changing. The market is changing, market is a great leveler, and that's why investors will be able to differentiate between men and boys and then buy those assets. There is an example of some of the insurance companies which actually came and hit the market. There's absolutely no doubt one side supply increased, and then each of them would have added cumulatively close to about 2 lakh crore market cap. Whether those issues were subscribed by the institutional investors purely on the basis of valuation, the answer is no. And people actually could differentiate, saying these are the issues not priced properly, therefore I will let go. So money managers also actually is not mindful of the valuations, and then they are able to decide what let go and what to own, and so on and so forth. And the challenge will still remain from an India point of view, which I think regulator also recently I saw a newspaper article about thinking about whether there is a need actually to increase the floating stock in the market. I think globally, if you look at the MSCI index is derived on the basis of the floating stock index, which is a free float that exists in the indexes. But India is relatively low on a free float basis. Therefore, whether time will come where the regulator will look at increasing the floating stock in the market, therefore the free float for a country as a whole goes up. Therefore, that brings in actually the balancing factor of adjusting the valuations. That's something I think could potentially, if it comes, it's good for the industry to actually bring in stable growth.
Concern and the deliberation around the fee versus commission that he touched upon. I really want to take your views on it, and how does the industry, respond to the regulators' questions over how do you deal with that? Again, there are lots of global practices that one sees, and we can take cues from the global markets. But in the Indian context, do you think there has to be some methodology that should be adopted which is very much tuned to the Indian terrain and not be just copy-pasted from the global international standards? Maybe Bala, you can start with that.
This of course has been an interesting subject. We of course keep harping all the time. I think Mahaling rightly put it, this discussion is going to remain forever. Because the cost is something which is going to be the integral part of the discussion in any forum. But having said that, the Indian mutual fund industries, the way they have behaved the last 2 decades or more than 3 decades, they only added value to the customer. Despite the fees rate could be a part of the discussion, they only add value to the customer, whether it is in fixed income. We have seen a single 5% interest rate regime, and with the expectation it will go down further. And even during that period, all of us used to charge anywhere between 1 to 1.5% kind of expenses. And now we are seeing back to somewhere around 7.5%, 8% or 9% kind of rate of regime. But despite having seen such a huge volatility, despite we charging anywhere between 1 to 1.5% expense ratio, the mutual funds are given return in excess of 8% for the investors.
Sure.
So therefore, I think the return expectations or return coming from the schemes is not derived by the expenses. It's actually derived by the ability of the managers to manage the money over longer terms. So therefore, that is going to be a point of debate. But whether they need to be addressed as something, in my view, is market will correct it.
Forces should decide is what Bala says. Milind, you agree?
Yeah, I think the debate is rightly, in some sense, being positioned as commission versus fee.
Yeah.
I would just like to say commission versus fee versus alpha.
Okay.
So you need to add the third dimension, because the story is not complete with the first two unless the dimension of alpha is measured as much. Because when you start generating less alpha or not generate alpha, I think, as in a way what Bala said, people will choose the cheaper option. And everywhere there is examples of people moving from option A to B to C driven by what they think is good for them, and not by either the manufacturer or the regulator or the intermediary pushing it on them, saying that this is what is good for you.
All right, customers should be given that choice, Leo.
There's one issue is cost. The other issue is how is a product sold, which is a slightly different issue. And I think the regulator's concern in other markets has been that in an environment where you have embedded commission in a product, the product typically is a push product. Where you have push products, and this was most sharply brought into focus in the insurance industry, you tend to have mis-selling. From that concern essentially stems the debate on fee versus commission. That if I'm selling a push product and that push product has embedded commission, you've now, by definition, from a regulator's perspective, raised the prospect of mis-selling. And therefore, there's a desire to push towards two extreme poles. Either you will be direct or you will essentially take a fee from a customer. The insurance industry, by the way, many years ago, elsewhere, tried to deal with this by saying either you will be tied to a particular single manufacturer or you will be wholly independent. Nothing in between.
Quickly, before I wrap up, I want to ask the biggest risk to the stock market that you see in the near term and in the mid-term, because that impacts your business straight away. Bala.
Market is bound by the fluctuation. I think the beauty of the market, it's a ratio of optimism driving the momentum.
It's sentiment,
and second is sentiment, optimism, and the valuations. The valuations, of course, is a point of debate, and the expectation remains very good. I think some of the recent steps that are taken by the government around the GST and all of them actually is pointing towards the making India fundamentally sound from the longer term point of view. Therefore, one has to have a high belief that the longer term outlook is good.
So short term pain for a long term gain, perhaps. All right. Milan?
I think I'll keep it short. Keep expectations moderate, but keep your conviction.
Wow. All right. The risks I was talking about. Maybe, yeah.
See, market has given good returns in advance. So we are in a slightly overvalued market. So we need to be careful when we are investing other people's money and reduce the expectations of people. Because today people have forgotten that equity markets are volatile. 8-9 months of non-volatility. Sometimes people say, when you try to caution people, they ridicule you that 8% will get, 10% means somewhere people have believed 15% they'll get if they invest in mutual funds. That's a done thing. It has happened in the past, it will happen in future. So that whole volatility has gone away. So I believe as the markets are going higher, people have to be prepared for more volatility that will come into the market and essentially get into more and more conservative funds. That's what I would say.
Thanks so much, everyone, for being a part of this interesting discussion. As we know, mutual funds inflows have been unstoppable, really. November, 40,000 crore rupees is what's come in, and we hope the momentum will continue from here on. Thank you very much, everyone, and thanks, panelists, for being here on the show.